Welcome, everyone, to episode 2 of the Stablecoin Solutions Podcast. It is my distinct pleasure to have with me today CJ Konstantinos. CJ is a Bitcoiner to the core, someone that I've been on several spaces with. He is the founder of People's Reserve Inc. He is revolutionizing the way we borrow, the way we lend, and the way we use Bitcoin in commerce. I'm excited to have this conversation with CJ because he gets what's happening right now with respect to the massive paradigm shift that is going on with respect to Bitcoin as a collateral asset, Bitcoin being integrated into banking, and how this all, of course, overlaps with stablecoins, which is my primary jam. So before we jump into the conversation, CJ, I want to give you a chance to properly introduce yourself and tell the audience a little about who you are and what you do in the space.
Well, first of all, thank you so much for having me. It's great to be on your second episode. I'm sure this is going to be a really good series. And I've learned so much from you just on spaces. So I know people are getting alpha when they come here, and that's why I'm happy to participate. Delivering value to the community and education is core, critical, and key. And that's really where it started for me. I went to school for accounting and finance. Then I found out, there's other ideas. There's other ways to think about accounting and finance, not just what I paid to learn. And that kind of blew my mind because I thought I was learning the best of the best. This is how you do it. Then you start hopping into Austrian economics. Then you find triple counting entries with Bitcoin. And you just start to say, wow, you know what? There actually is room for innovation and progress within the fields of finance and money, which is interesting because in school, when you learn about banking, finance, and money, it's at the top tier. You can't beat it. It's the best of the best of the best. It's the best it will ever be, and you can't make it better. And here's how it works. But in reality, it's like everything in life. It's a moving goalpost, and you always have to move forward, and you always have to get better if you want to experience a more abundant life. And banks are now being put in that position. So a little bit about my history. I've been in Bitcoin over a decade. I started buying Bitcoin at $150 as a speculator, like most people.
Where were you in my life when Bitcoin was $150, CJ?
Yeah, a lot of my family and friends say that. But the truth is when I told them about it, it got to the point where dude, stop telling us about this. We don't want to know anything else about Bitcoin. We don't want to know about Ether. We don't want to know about any of this stuff. Thank you, but no thank you. Then, of course, a few years later, Bitcoin hits $20,000. And all of these projects that nobody knew what they were, all of a sudden became in the industry household names because they had delivered 1000x plus returns. And now all of a sudden people wanted to come back and say, hey, what can you teach us? So that gave me a good chance from that early time. They start coming back around 2016. And that was right around the time where at that point I got into mining. I was doing pretty much everything you could do in this industry because I just was amazed that there was an alternative system to what I thought was really the only system. I knew gold was outside the system, but it's just gold and it's just outside the system. It wasn't an alternative. And I'm sure in the call we'll get into that later about how there is this alternative system and the world has really not understood that system. But boy, is that system gaining momentum. And we're now seeing it in the real world here today with Bitcoin just under $100,000. Stablecoin issuer Tether being one of the largest holders of U.S. Treasuries in the world, even more than countries. And then at the same time, a funny thing right now, the market is bearish. So
yeah, we should probably put a pin in that and say that we are recording this on November 14th, and we have seen a precipitous drop, relatively speaking, in Bitcoin. Markets are not looking great right now. All the alts are also bleeding as we speak. Everyone is turning bearish. What are your thoughts on all that? Because we got to touch on that.
I absolutely love it. If there's anything I've learned in this industry, when people get excited and come back to you, probably time to scrape some off the top and get ready to buy the next bear market dip. But at this point in time, the sentiment is the fear and greed index is one of the lowest I've ever seen it. Last time I checked, it was at a 15. I think the lowest I ever saw it was at 7. So it's
right? I don't think it was this low when we had the invasion of Ukraine and we had that flash crash of Bitcoin.
Yeah. See, Bitcoin is not volatile because one Bitcoin is always one Bitcoin. The volatility is in the human psyche. And that's why I love, the psychology of the market cycle. If you don't know how to read the charts, if you don't know if it's the right time, whether you should be getting in or getting out, take a look at the overall sentiment in the marketplace. And if you told me 4 or 5 years ago, CJ, one day Bitcoin will be trading at $97,000 and people will think that it's over. It's done. It's going away. It won't be here anymore. Well, that was the same thing I thought about $5,000 and $10,000 and $20,000 and $50,000. And now $100,000 is just the next stop. And it's not about the number, it's about the psychology. So $100,000, I think, is an important psychological level. But look at who's happened. Larry Fink, Jamie Dimon, all big players who said they were not for Bitcoin and were against Bitcoin, or even going as far as saying Bitcoin is going to fail and go to zero, are now embracing Bitcoin and building products and services around Bitcoin, with BlackRock's IBIT ETF being, in 1 year, the most successful ETF that they've ever launched. So times are changing. The institutions are here, which is probably why we have this sentiment, because they want people out. They want the cheap coins. They want people afraid, because they know ultimately what Bitcoin becomes, you mentioned it earlier, is the equity layer foundation of the entire financial system. We need to plug back in an equity layer. We might need to use both gold and Bitcoin. I'm not really quite sure yet, but we need to plug back in that equity layer, because the debt-based system is now to the point when you extend credit, you're not getting the economic growth required to deliver value from that printing. And that's where stablecoins come in, and they're embracing it. They know they need to embrace it.
I've heard you talk many times about Bitcoin being pristine collateral. Of course, Saylor's been saying that for a long time. I think you are up there with Saylor as far as being a great evangelist for Bitcoin and its real world use cases. And I actually had a chance to see Saylor speak last month in Connecticut, and he spoke to a small gathering of family offices, and he definitely caught their attention. So we are at this point now where we're starting to see Bitcoin be integrated into financial rails, become legitimate as its own standing asset class. It has been time tested and battle tested. We're even seeing banks now talking about integrating it into their systems. Are you excited about this, or are you worried that it's becoming too institutionalized?
Yeah, so I think maybe the old CJ and back in like 2013, 2014 would be like, oh man, this is not a good thing. But the more and more I learn, I think my big advantage was I have the education on the traditional side. So it's not as conspiracy theory like, for lack of a better way to describe it, for me, as it is for some other OGs, probably some of the ones who are selling right now and start to see, man, Bitcoin's become very tied to politics. It's getting integrated into the system. This is the opposite of what I thought it would be. But if you game theory that out and you just think about that for a second, and you deep think and you say, well, wait a second, how could Bitcoin ever become the world's reserve asset, the equity layer foundation of finance, if it's not used by every single financier, good and bad? Right. So to get to this point, to where Bitcoin is going, it will swallow up everything. It has to swallow up everything. And the one thing I find my rest in, and I hope other Bitcoin OGs can come to this conclusion as well, is that famous saying that we all know is so true. You don't change Bitcoin. Bitcoin changes you. Well, so guess what?
Does People's Reserve do to help integrate Bitcoin into their life as a collateral asset? Tell the people what you're doing and what services you're providing.
Yeah, absolutely. So our key philosophy is that Bitcoin is engineered money, that it was strategically designed to leverage the natural laws of economics and finance and price discovery to deliver value to the holder of it. And that is really found in absolute digital scarcity, the ability to know that more units of this construct, we call it money, more units of this money cannot just be created. So the value of that is turns it into what we call digital gold. And what Bitcoin does is it becomes the most pristine form of collateral in the world. How does it do that? For your listeners who are like, what's collateral? What, pristine collateral? What does that mean?
Break it down.
So let's go back to when the gold was backing the dollar. So when the gold was backing the dollar, it was a pretty decent collateral. Remember, these paper units we use today were representations of the gold. They were a technology that was used so that you didn't have to shave gold off in the grocery store. That
A
allowed
little hard to move
monetary.
gold around, right?
Absolutely. So monetary velocity, or the speed at which money changes hand in the economy, was limited. But by issuing paper notes that represented the gold, we were able to increase monetary velocity and allow the economy to expand. Funny enough, Bitcoin faces a similar problem in its design, which is why these L2s and stablecoins are going to be so important. You're going to save in Satoshis and you're going to spend in stablecoins. But getting back to what we do with so gold was this asset, and the paper was the liability. Gold was the asset backing the circulating liability. Well, gold as a collateral, like you just stated, very expensive to secure and to transport. So if you're posting gold as collateral and you have to settle with somebody across the world, there's going to be time friction and cost friction in that settlement process. So the system itself looked at that and said, okay, no problem. Let's use treasuries, because now we have this interbank system where with settlement plus 2 or 3 days, boom, you got it. It took gold 2 or 3 weeks and lots of costs to get to where it needs to get securely. With paper,
and it's impossible
treasuries,
to inventory it, to value it. There's a lot of problems.
fraud as well. Yep. You see the gold with the tungsten in the middle. I mean, all of that stuff is an issue that's not completely auditable, but it was hard. That was the good thing. It cost money to pull it out of the ground, so you couldn't just expand it infinitely. So the treasuries come in and solve the problem that gold had, which was the cost and time friction to settlement. You get settlement within 3 days, no problem. But it created a new problem, which was the ability of the government to expand the supply ad infinitum. So what happened is now you have this collateral where you lend the government money, or you're lending somebody else money, and you're giving them treasury collateral. And it's fantastic because, hey, if you need to settle in 2-3 days, no problem. But now the new issue is, especially since 2020, and Bitcoiners been shouting this problem out since the launch, right? Since the white paper of Bitcoin. It came after the banks in 2008. So this was the core issue but only recently have people been paying attention to it, because the rate and pace of the inflation since 2020 during the shutdown, when we closed everything and then printed to pay for it. And that
we
inflation,
have this massive debasement of currency, right? We're running at a $38 trillion deficit. We're adding to it at astonishing rates. Our money is buying less. People are starting to lose faith in fiat currency. And now Bitcoin seems to make sense to people, right?
yeah. And I'd say, even though the textbooks will try to say you need 50% inflation per month for hyperinflation, if you go back and you study each and every economy that went through a hyperinflationary event, there's one thing in common, and it's not the mathematical rate of inflation, it's trust. So it's the trust of the people and the users of the currency. So the only difference between inflation and hyperinflation is trust. And bringing Bitcoin back into the system is what's going to build trust. And here's why. Because we lost that trust with the treasury collateral, because as you're holding that collateral and they're printing more and more of it, the collateral is becoming devalued. It's almost like a car. If you're an auto lender and the car collateralizes the loan, you drive it off the lot, it loses value. Every single mile you put on it, it loses value. The kid spills something in the back seat, it loses value. The car is not a good collateral because it loses value. Well, the treasury started out as a good collateral because the abuse of the treasury was limited. It was based on our need to print money to service debts of the world, or else we have deflation, right? So that was where it came from. But now that it's being abused to the extent of $2 trillion per year, with $38 trillion of debt and over $200 trillion of unfunded liabilities that come in the form of knees and hips, which are the prices of those are going up faster than any of the yields that are being paid. So we have this problem, and Bitcoin comes and says, no problem. Here's what we're going to do for you. I'm going to upgrade gold, and I'm going to upgrade the treasury. I'm going to upgrade gold from from being hard and having a cost to pull out of the ground, to having limited supply expansion, to absolute digital scarcity. I'm going to upgrade gold in that you don't know, you have to test it and you have to make sure it's real and you have to check the purities and all these other things, to completely verifiable authenticity. 100%, that's the real deal. So we get absolute digital scarcity and absolute truthfulness and trust in Bitcoin. But then it says, but I'm not done. There's more. That's good. What's the treasury do? I'm going to upgrade that. Forget about your 3-day settlement. I'm going to give you settlement in 10 minutes. So Bitcoin becomes the best of gold and the best of Treasury collateral. And that's why at People's Reserve, we call it pristine collateral, because it is truly the next reserve asset of the world. And when you use it to answer your original question, when you buy Bitcoin and you have it on your personal balance sheet, you should never sell your Bitcoin. I'll share a story with your listeners. In 2019,
I want to talk about this. I know what you're about to tell me.
In 2019, I bought my first single family home for 100 Bitcoin. And of course, in 2019, we're in the bear market. So I'm looking at my wife. I'm like, we're in a bear market. What are you talking about? She's like, if you want to have kids, if you want to have more kids, house, kids, Bitcoin.
What rule did you break? You broke your own rule. What's your rule number one?
Never spend your own Bitcoin. Always just borrow against it. It is, and something magic happens. So this is the real empowerment. So the way I described gold as a collateral was kind of from the lender's perspective, which makes it extremely interesting. And it's why it's being integrated. But what about from the borrower's perspective? What about the everyday person? Well, the great thing about Bitcoin collateral is it does the opposite of your car. So as your car becomes worth less and less over the life of the loan, the Bitcoin becomes worth more and more over the life of the loan. And this is an amazing thing, that this is an idea that we are trying to educate at People's Reserve. And you'll hear nobody else talking about it, but you'll see it in our products. In traditional credit, when you go and you make a promise to pay, and you promise to pay somebody back in 2 years, and then you promise to pay someone back in 30 years, well, it costs more to pay back the promise in 30 years. You're going to get a higher interest rate. They call it a term premium. And that's because the risk of that promise being broken is greater. And they call that duration risk. So the longer the length of the promise, the greater the chance that promise is broken. So you pay a term premium.
Tell the folks at home, Johnny, how much that Bitcoin you spent on the house is now worth.
Yeah, so I bought my house for 100 Bitcoin, and oh man, it just hurts to say that. So today that Bitcoin is worth over, well, with this little dip here, I think it's worth just around $10 million or $9.8 million. And I can promise you, I am not walking into a $10 million home when I go home. I'm walking into your average single family home, just over 2,000 square feet. And that created a pain point in my life, right? That I needed some type of product where, and here's the thing. Yes, there were lending products in 2019, but they all are Bitcoin on margin. So if I had put up 200 Bitcoin so that I have a 50% LTV and give me a little bit of a buffer, and then we go into 2020 and we have the COVID event, I would have been liquidated.
Yep.
I would, because Bitcoin went from like 10,000 all the way down to 3,000. Right. So I would have lost 200 Bitcoin instead of 100 Bitcoin. So I knew we had to create a product that eliminated price volatility based liquidation risk.
And how do you solve for that?
Yeah, so at People's Reserve, we actually cross collateralize. We dual collateralize both property title and Bitcoin. So even if Bitcoin goes to zero, which none of us believe, but even if it did go to zero, you're not getting a margin call. You're not getting liquidated. The loan is still secured by the property title. So by cross collateralizing, we completely remove the price liquidation risk, which I think is, I mean, imagine if I had to go through that and I wouldn't have been able to sleep at night. So you buy a home and you're not even able to sleep at night because you're just watching the charts the whole time. And Bitcoin is a pristine collateral, right? So it should come with this type of safety mechanism built within it. And we believe over the long run, because it gains value, it turns that duration risk I was just talking about that comes with a term premium, it turns it into a duration benefit. So from the lender's side, the risk is in the short term with the short-term volatility, but with the long-term price growth, we get duration benefit. Duration risk actually goes negative in the long term, and the Bitcoin collateral will reduce the burden of the debt for the borrower. So of course you're going to keep making payments. You don't want to pay off the debt. You want to keep your Bitcoin, but what you're going to be able to get really cheap interest rates, because if Bitcoin is over collateralizing your loan, you are eliminating the risk for the lender. So your cost of capital is going to decrease. And when your cost of capital decreases, you get more free cash flow.
Do you think, CJ, that now that banks are getting more comfortable with the custodying and the opportunities that Bitcoin offers, that they're going to start to offer similar services to what you're offering?
I don't think so. And here's why. Because they don't believe in Bitcoin as an engineered money. They don't understand it as an engineered money. They understand it as a speculative asset that trades correlated with a tech stock. So right now, they're happy to let you borrow against it on margin like you would your stocks. But they do not think of it as pristine collateral. They think of it as a less pristine collateral than a treasury, a less pristine collateral than a big stock like Tesla or some mag stock. So in their minds, what they are missing is the over decade of experience of diving into Bitcoin head first and learning about the protocol, getting involved with the network through mining, learning about cost of production and the difficulty adjustment, learning about the actual design of Bitcoin, the engineered design that leverages those natural laws of economics. They don't see that at all. They just see a speculative coin. And by the way, anybody can create a coin. Anybody can copy, paste, and create a new Bitcoin. So eventually there'll be competitors, absolutely, especially when the products are proving themselves in the marketplace. Right. But in the short to medium run, there's so much of a gap of understanding. I mean, it's you and me. Remember when we had our first orange pill? You're just like, oh, okay, cool. Like, but what you know, it's like that song. I wish I knew what I knew now back then when I was younger, right? Because if you knew what you knew now, oh man, would you be? I mean, back then I already sold my car and sold everything. I liquidated all my stocks and got in. But I had nothing. But I look now, I'm like, oh my goodness, like what I could have done, what my family could have done, where'd they be at now if they had just listened? And what's amazing about Bitcoin is that same opportunity is still here today. Like
people feel like they're priced out of it. There's a unit bias to Bitcoin that I think a lot of people have. They look at other assets that are lower priced and think they have more upside possibility because they don't understand exactly where this is going. They're not seeing where the puck is going. And now we have an interesting dynamic that's come into play because now we're starting to see Bitcoin being offered as a potential currency. The former founder of Twitter, Jack, has started to offer point of sale payment with Bitcoin. This breaks rule number one because you're not selling your Bitcoin, but you're spending your Bitcoin. So buying that cup of coffee with Bitcoin, when you factor in all the things we just talked about, to me, doesn't seem like the best use of your money. That's why I've been pushing the narrative, stack in sats, spend in stables, and make your wallet your bank, because I think we still have to have a bridge between getting collateral on your Bitcoin and spending it for real world use cases. I'd love to know your thoughts on this as we start to get deeper into the Genius Act now and what stablecoins are doing to this whole paradigm.
Yeah, fantastic question. And it's a two-part answer. The first part is that you got to know the difference between money and currency, right? That is a core critical foundation. Money is a store of value. Currency is a medium of exchange. So money, Bitcoin as a money, is a savings technology. And the dollar, tokenized dollars as stablecoins and a currency, is a spending technology. So you should save with savings technology and you should spend with spending technology. And then if you really go to the next level, now you get into the borrow, right? You borrow against the money so you can spend the borrowed currency. And as the borrowed currency devalues over time, that dollar denominated debt against your money, which is accruing value over time, the burden of the debt is actually decreased. So you have that great advantage. But to get back to what you were saying, what's interesting here is that a large segment of the Bitcoin community believes in like the buy and replace thing. And I'm not necessarily against that. Like, in other words, I'll take my paycheck and I will keep what I need to spend in the spending technology in the form of dollars. And then I'll take my savings. And since I don't think there's a better investment opportunity than Bitcoin as a savings technology, I'll take my savings and I'll put it all in Bitcoin. And I won't wait for ups and downs. I just immediately put it in Bitcoin. And then I spend my dollars. But what's interesting here, and I think we're moving into this time period now, and it's not from the consumer angle, it's actually from the merchant angle. Because what the merchants are getting are a discount, right? They're paying upwards of 3% sometimes on credit card transaction fees, and that eats your bottom line. So what's going to be really interesting is when you are incentivized to spend your Bitcoin as dollars, right? Because the merchant can receive it however they want. And the merchant's actually going to start giving you discounts. So if you start using this alternative technology that's on Bitcoin rails, even if it's dollar to dollar, even if it's dollar into Bitcoin settled in 10 minutes back into the dollar, they avoided the 3% surcharge. Right. And that increases their bottom line. So they can turn around to you, and the aggregate of that 3%, they can turn around to you and start giving you discounts. Merchants will start to incentivize you to pay over Bitcoin rails or to directly spend your Bitcoin because they're making more money when you do, and they can share a portion of that.
And the same thing applies to stablecoins, because it's funny you brought that up, because I just got done recording a TikTok where I was talking about that very issue. Why do we need credit cards anymore? What is the point of credit cards? And I think credit card companies themselves understand that with stablecoins. Let's set aside Bitcoin. Stablecoins backed 1-to-1 by U.S. Treasury reserves, as long as we can still have that full faith and credit and the trust that you talked about earlier. Now, as a business, you'd rather accept stable coins because they're redeemable immediately. You don't have to wait days for the money to come into your account. You don't have to look at that 3 to 5% extraction of your money going to the credit card processor. So really the only thing that credit cards solve anymore is, yeah, you have the ability to reverse transactions. And the bigger thing is you give the consumer float. But that float that the banks are offering consumers on credit cards comes at a steep price, 25% on average in interest payments on credit cards. So they're becoming less and less relevant. And like you said, and I love how you said it because I agree, you're going to have a paradigm shift now, because you're going to have businesses saying, hey, instead of me charging you an extra 3% because you're using a credit card, heck, I'll give you back 3% because you're using a stable coin or you're paying in sats. But I'm still not 100% convinced. I want you to convince me and the audience, why would I want to spend my precious sats if I think, like many people think, that it's going to go exponentially higher? Why would I spend, even with that little 3% discount? There's so much downside to giving away my sats to buy that cup of coffee when I think about what they'll be worth in 5 years.
Yeah, absolutely. There is no argument against that. You have the perfect saying: stack sats, spend stable coins. That's what you want to do. And I think that it's the second element there, spend stable coins, because the float is the really key critical point here. Float. Let's talk about the credit extension. Yeah. Because that is, people are able to extend their purchasing power, and the price they're paying for it is at rates of usury rates. And what happens now is credit cards and credit businesses are tied directly to banking partners, and banking partners are dependent upon the traditional yield curve. And the traditional yield curve comes with stated and anchored and yield curve controlled interest rates. So what does that mean? We don't really have a true free market expression of cost of capital. And historically, we've suppressed those rates, especially through the zero interest rate policy timeframe, what they call ZIRP. So cost of capital was really low. But we're entering a time frame now where the Fed is trying to lower rates. But if you look what happens, even the yield curve is staying neutral. It's not inverting like it typically would. People are actually saying, oh my goodness. In fiscal dominance, in other words, when the government has to spend so much money beyond that what it collects in taxes, and it's forced to issue new debt to service its debt, we are in fiscal dominance. The spending dominates the overall macro, and that sucks value out. So I'll make a radical statement to some of your listeners. I believe we're at the point, because of fiscal dominance, that the United States Treasury couldn't raise interest rates to increase demand on treasuries, even if it wanted to, because the rate at which that cost increased, it already has put our interest cost above our military spending. We are now spending over $1.2 billion on interest cost. And with every basis point where that rate increases, it's going to be a tremendous interest cost. And it could actually overtake the Social Security and healthcare if they raise interest rates. So imagine paying the most just for interest. So that actually creates more inflation, because you are now servicing a debt, and you're increasing the size of your own debt by increasing the own interest you have to pay on your own debt. And when you get into that scenario, you can only bring interest rates so low because marketplace participants are going to seek protection from inflation. So they have to find this magic area where it's like the neutral rate. But what's happening is there's an alternative domain called decentralized finance. And banks do not plug into decentralized finance. And in decentralized finance, the interest rate is based on the supply of money, the demand for loans, and counterparty risk. So not that long ago, you could plug into a DeFi protocol and you could borrow dollars for less than 1%. Now let's remember, when the federal funds rate is less than 1%, That is an interbank lending rate.
Yeah,
That is not the rate that you
you're
and I
getting
get.
Fed wire rates.
Yeah, be your own bank takes a whole new meaning. So you put Bitcoin in your bank wallet and you become your own bank, and now you can borrow at interbank lending rates instead of usury rates. So this float, which is the last selling point the credit card companies really have, is being eliminated. That value proposition is being replaced by Bitcoin becoming the equity layer foundation in decentralized finance, and stablecoins becoming the expression of that purchasing power, not just in the internet economy, but in the real world economy, with these new debit cards popping up. And there will be a version of a credit card where Bitcoin is used on margin as well. So all of this liquidity, all of this wealth that was created inside the internet economy, which is the best economy in the world. It has no debt. No one person can control it, and no one person can outcompete it because it's an aggregate. So this free market economy is offering up liquidity, and you just need to post collateral. And the best, most pristine form of collateral is Bitcoin. And what do you do with it? You borrow these stables. And now you're borrowing these stables. Instead of paying the credit card company 26%, you can borrow these stables for the interbank lending rate, whatever it is. And it adjusts. It adjusts with the supply of money, the demand for loans, and counterparty risk. So if you want the lowest rate, provide a significant amount of collateral and borrow very little against it. And this is what truly empowers the user. This is where the world is moving to. It's not going to be the credit card companies and the banks that are going to innovate. It's going to be the decentralized internet economy that people can plug into through Web3 that offers opportunities that the traditional world can't offer. Even if they wanted to, they couldn't offer it because of all the overhead and cost, right? Look at a bank. Banks have 10,000, 20,000, 50,000 employees. How many employees does Tether have? The largest stablecoin.
Right.
56 profit per employee. Tether is leading the world.
Yeah,
so
it's a textbook. People will be writing textbooks about that business model.
Absolutely. So the cost of providing these products and services to the marketplace is significantly cut when you put a bulk of the work on a smart contract. And yeah, there's still going to be real world, like People's Reserve. I consider us like a C DeFi. We are your centralized agent brokering access to DeFi for you. And you can look us in the eyes. You can shake our hand. You can get a white glove service. We'll walk you through it. No problem. But ultimately, the products and services are empowered by Bitcoin and empowered by the decentralized financed internet economy. And that is where we're moving at a very accelerated pace.
I love it. For the folks at home that have kids in the room, cover your ears because I'm going to say something that I've said before publicly. But with the advent of stablecoins under the Genius Act, I have been pretty vocal that banks are fucked. And I mean that in the way that banks that don't adapt to this, that continue to stay married to their fee extraction model. And I think it's important we touch upon this because when we're talking about moving money at the speed of the internet, what we're really saying is no longer moving money at the speed of banks. When we're talking about DeFi and moving money over smart contracts via cryptocurrency rails and via stablecoins that are now on the heels of the Genius Act being signed into law, these stablecoins are going to be backed one-to-one to not the most perfect reserve, obviously Treasury reserve currencies. That's still the existing model. And we'll get to why this is going to be an evolving conversation. But banks have extracted fees from consumers to move their own money in exorbitant ways. ACH wire fees, both coming and going. I now see them show up in my bank account to receive wires from clients. We're also seeing that we're married to banking hours, which is antiquated. When you talk about moving money overseas and what SWIFT requires and currency conversion and FX, banks are largely at an existential crisis here because if they don't adapt to what's coming with stablecoins, they're in trouble. Now, I want you to talk a little bit because I've heard you talk about it before and you perfectly nail it. What is fractional reserve banking and what does that do to this entire paradigm that we're talking about right now? Because we have FDIC insurance and we have fractional reserve banking. And I think people need to understand, why do those things exist?
Yeah, great question. And it's funny because when I first started, I didn't know fractional reserve banking. Banking was banking.
Yep.
And I thought, oh, banking is bad. But actually, banking is good. Banking delivers a good value proposition to the economy. It's fractional reserve banking that creates the problems. And what does fractional reserve mean? It means that the bank is able to take your deposit and then extend the value of that deposit into other investments, and not for your good or benefit, but for their own good or benefit. So they use your deposit to make bets in the market. And people don't like when I say make bets, but when you look at reserve ratios, since COVID, the reserve ratio, goose eggs, baby, 0, and it hasn't changed. That's a big issue. So now it's Basel banking. It's based on a bank's risk metrics and what they want to do, right? It's all blah, blah, blah. Sounds great. But in practice, what happens is the Bank Term Funding Program. What happens is what happened to Silicon Valley Bank in a couple of years ago. And that was just based off of interest rates. So the Fed starts raising interest rates. The bank, remember, the bank is stuck because they went through the zero interest rate policy timeframe where they were forced out the yield curve. So they would have held Treasury bills or notes, but instead, because those bills and notes were so low yielding, they got forced out to the bonds so that they can get some type of yield, so they can make some type of profit. And those bonds are 30 plus years, 20 plus years.
Why would you hold that anymore in this world? I mean,
significant duration risk, because you know why? It's not their money. So they don't really care about the risk. They just care about the profit. So
and then they're lending out on that risky product.
On top of it. So your bank deposit, my bank deposit, everybody's bank deposit. Best case scenario, every single dollar you have in the bank is backed by about a dime. Worst case scenario, every single dollar you have in the bank is backed by a penny. And possibly in certain situations, there's actually negative equity. So that's the concern with traditional bank deposits, or what they call demand deposits. It's fractionally reserved. If everybody comes back at the same time to get the dollar that they say on the screen is theirs, the dollars don't exist. And that is why we have the Federal Deposit Insurance Corporation, FDIC. FDIC is there to say, hey, if there's ever some type of bank run or something like that, we will step in, we will provide the liquidity to make sure that the depositor doesn't lose. And that's exactly what we saw at Silicon Valley Bank when the Fed started raising interest rates. These were big tech companies and savvy financiers who said, well, wait a second, I'm not going to keep my money in SVB and get paid less than 1% on my savings account when I can then move my money into a money market fund backed by US Treasuries and get 3%, 4%, even got as high as 5%. So that incentive to earn that yield backed by the full faith and credit of the United States government versus earning no yield or basically no yield at the bank, that made deposits say, hey, I want my money back and I want to go to the money market fund. Well, the bank, they cannot just take the liability and send the liability to the money market fund. They need to send the corresponding asset, which means they need to sell whatever asset they hold that is backing that liability. But here's the problem. The way that these bonds work, when the interest rates go up, the price goes down. So they would have been forced to sell at a loss, and they would have locked in billions of dollars of losses, and the banks would have collapsed. So the Federal Reserve stepped in and said, okay, no problem. This is a temporary issue because we have to hike rates to fight inflation. So we're going to create the Bank Term Funding Program. What you do is you bring that collateral that you have to us, and we will value it at par. We're not going to force you to sell it on the market at a loss. Just borrow against it at the par value.
Absorbing the bank's balance sheet.
100%. They're absorbing the negative equity on the bank's balance sheet so that the depositors could actually move their money from the bank to the money market fund. Now how many people actually truly understand that? Probably nobody. Like 1 out of 100 people probably understand that. And that caused the collapse. Now, many people will understand this, which is the value proposition of a stablecoin. Hey, I just had to go to the ATM and take out $100 and I just had to pay $5. What? By the way, I have to make an important deposit tomorrow, but it's Sunday or it's Saturday and it's 5:00. This is crazy. Oh, hey, I'm going to buy a new car. I need $25,000 cash. I hope you're ready to ask for permission. So the value proposition of stablecoins is 24/7, 365 money, 24/7, 365 access. No asking permission from mommy and daddy if you can move more than $10,000 from one account to another account, or if you can buy a car and actually help out the economy. You don't need to ask permission to do that. No more being destroyed when you need to get cash in your hand, because now it's being given back to you at one to one, right into your account, whatever account you attach to your provider, 1-to-1. fully reserved, no Federal Deposit Insurance Corporation required whatsoever. Because if every
Bingo.
single person wanted their money back at the same time, it's all there. Everybody can get it back. The
Has
worst
to be, because under the Genius Act, there are steep fines if you depeg, which is what the Genius Act has solved for. Because before the Genius Act, we had the concern of USDC and Tether. Would they depeg? Now we have solved for that, and they're bankruptcy protected. So you don't need FDIC insurance on stablecoins, right?
You do not need it. You do not need it at all. So I always thought, as a longtime Bitcoiner, I thought Bitcoin was going to bring down fractional reserve banking. Turns out it's not. Stable coins are going to destroy fractional reserve banking. The fractional reserve model is no longer the prominent banking model. That's why Tether is the most profitable company in the world, because they have a fully reserved bank, and is the fully reserved banking model. And their banking model, because it's not under Genius, they actually do have some gold. They do have some commercial debt. They don't just hold
Bitcoin.
U.S. cash and cash equivalents. And Bitcoin.
Paolo's buying Bitcoin like crazy.
Yeah. So that's why they created that new US based one to be Genius compliant. Right. And they'll be able to serve global markets where they optimize the yield that they're getting on the corresponding asset, and then US markets where they're dependent upon the US yield curve to make a profit. But ultimately, what that means is, because even the ones where they have less profit that are Genius secured by the Genius Act, which is great and really important for the industry, they're still going to take that liquidity and plug it into DeFi, and they'll be lending that out, and they'll be earning there more than they're going to be earning from the Fed, especially after Powell gets replaced in May and a new guy comes in. These rates are going low, 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 low. The market is going to be starved for yield. These savers, these savers since 2022 are going to turn into spenders and investors. And we are going to get a second wave of demand on consumer goods, and we're going to get a second wave of demand on assets, and we're going to have a double wave of inflation, and it's going to be, it might actually affect the 2028 elections. I think it's going to be that big of a move in asset and consumer prices, unfortunately. But again, if you're stuck in the regular system, you should be afraid of this, because you might actually have to interact with FDIC. You might actually have to wait 6 months to 2 years to get your money back. But if you're detached, if you have something in the alternative system, if you have something in the internet economy and something does go wrong, you still have something to barter with. You still have something to trade with. You still have something that you can move without permission. So whether you are fully invested in this movement or you're just now learning about it, it's time to get your foot in the door. It's time to have not just diversification within your investment and lending portfolio, but also diversification within the systems, systemic diversification with where you have your purchasing power. And that's going to allow you to protect your family and sleep easier at night.
I love it, because, and we've talked about this before, the dollar is in crisis. The demand globally for treasuries is going down. Scott Bessent, who is in charge at Treasury, is making a very calculated bet here that under the Genius Act, stablecoins will create global demand for treasuries, which will create global demand for dollars, which will ultimately be a net good for the United States. And this is a calculated gamble, because it's at the same time that, just as you discussed, we're seeing a push to bring rates down. So this now affects the profit model for stablecoin issuers, because they make a lot of their money on the yield. And the consumer is smart now, because they've got all these new things that you just talked about. That's why the banking sector is fighting so hard to prevent consumers from going out and earning yield on stablecoins, because it disrupts the apple cart. They can't earn yield as stablecoin issuers. Stablecoin issuers cannot pay out yield, because that is a contagion effect, which is the rehypothecation of these assets, which puts them at risk, and that's expressly prohibited under the Genius Act. So do you think, from a global macro perspective, that this calculated bet by Bessent is going to work, that the demand globally for treasuries under the Genius Act and the incredible demand for stablecoins is going to keep the dollar alive, and it's going to solve some of these problems as far as our increasing deficits? Do you see this playing out the way they think?
I don't think it's going to solve increasing deficits, but I do think it's going to increase demand, because when you look at everything in the fiat world, the dollar is still the best, right? Even though the dollar is being inflated, see, the value proposition of the United States of America is the law. That's really what
And the
outside
military.
investors come here. So the
military.
Yeah, so having the military is definitely important. I mean, there's no doubt about that. But when you talk about capital flight and why is global money coming into the dollar? And if your listeners don't know, look at the euro dollar system. There is a dollar system outside of the domestic dollar system because there is so much demand for US dollars. So there is literally an alternative euro dollar, not like euro, like European currency units. No, it's called euro dollar because it is a dollar home base of liquidity located outside, created by banks outside, dollar liquidity created by banks outside of the domestic USA system that's supervised by the Federal Reserve. That's how much demand there is for dollars. That's how we can keep kicking the can. But why is there so much demand for dollars? Because it goes back to that saying, we are the cleanest shirt in the dirty laundry. When you look at the other countries and the debts that they are issuing, and you look at their economy and you look at everything that they're doing, we are the closest thing. Our socialist capitalism is actually the closest thing to free markets in the entire world. And we have legal enforceability. If you go into some of these other countries, yes, they have court systems. Yes, they're first world countries. But the way that the law works, and you can attest to this being a lawyer, it's not as structured and it's not as protected. You could bring a case to the Supreme Court if you needed to, but over there, yeah, you can bring it up to the next court, but ultimately what's really going on behind, it's not trustworthy. The legal system is not trustworthy. The United States has the most trustworthy legal system in the entire world. And that is where you get the transparency to protect your assets. It's about property rights, and it is easiest to protect your property rights in the United States of America. That's why we have demand on the dollar globally, even outside of the domestic banking system. But that outside international banking system, that euro dollar system, we are not the direct benefactors of that system. The United States of America and our economy don't really benefit from outside banks that are not regulated by the Fed extending dollar liquidity. Now, of course, they have that right. They figured that trick out in 71 when they were extending liquidity and coming back for the gold, right? So that created that whole problem. But now we actually have a solution. Tie it to the stablecoins. Use the law with genius to secure the stablecoin and to make sure that that is enforceable in the court of law. Protect that capital. And what we'll see is people all over the world who don't have access to a good spending technology like the dollar, a spending technology that is accepted universally, a spending technology that is legally protected. And of course, with the stablecoin benefits we talked about too, always accessible, no permissions needed. So all of this global demand, what's happening is other countries are going to be in trouble because people aren't going to buy their debt because they're going to want the genius protected US-based stablecoins instead of these Fugazi paper notes that are backed by a penny or 10 cents, especially from an international bank. So it just doesn't make sense. So for that reason, I think there is going to be extra demand on treasuries. That is going to allow us to finance the deficits without quantitative easing, or in other words, without the Federal Reserve actually having to directly buy the debt to provide the liquidity.
So they don't have to absorb it anymore.
Exactly. And that's going to help. But I do think though that one thing that what we really need to think about is that Bitcoin has to be in part of the picture. Like I was
going to ask you, I want to pivot to that question because now that we've got stable coins that are coming online, fully regulated, that's going to create this global demand. We have Bitcoin being institutionally adopted. We're seeing it integrated into the rails of traditional finance. I want you to kind of give the blueprint for how you see this unfolding, how, Michael Saylor's got his take on this. You've got your take on this. I want to know your perspective on how Bitcoin as pristine collateral can merge with stable coins to be the new decentralized rail that eliminates the need for reliance on banks.
Yeah. So spending that stable coin over the Bitcoin rails is a no-brainer. You immediately get that saving. But I think the real advantage here is going to be, and I think maybe I'll just give an example. So this, please, for those who are listening, I'm actually working on sharing this information right now. I haven't shared it, so it'll be the first time I say it publicly.
All right.
But I think it's a really powerful example. And I think that it'll be a light bulb moment of why Bitcoin is so important, right? So we have the stable coins, we have Genius. This is amazing first step. This is unbelievable that we are, compared to where we were in the previous administration, which was a war on this stuff. This is amazing. So we are taking the right steps, but we must integrate Bitcoin into our economic, monetary, and fiscal policies if we want to escape the problem, because stablecoins alone are just a derivative of the Treasury, and the same problem still exists. So it creates a lot of benefits for both lenders and borrowers and merchants and consumers. But from the Bitcoin side, let's talk about what we can do with Bitcoin, because it's no longer just a store of value. With what you see Saylor doing at MicroStrategy, it's now a cash flow product.
Right.
And what you see us doing at People's Reserve, it's now access to cheap, affordable credit. But there's a fourth element here, which is it's an insurance. So because Bitcoin is an engineered money that gains value over time, at People's Reserve, we realize that not everybody has the ability to post Bitcoin collateral, right? So what happens when someone wants to come buy a house, be empowered by Bitcoin, but they don't have any Bitcoin? Well, we are creating a Bitcoin mortgage insurance product. Now, what's so interesting about this is that your users might be familiar with private mortgage insurance. So when you go to buy a home, if you don't put down 20% as a down payment, you're going to have to get private mortgage insurance.
PMI.
Now PMI. So this PMI is designed to reduce risk for the lender, right? Because you have very little equity and title is covering the majority of the loan. So you pay an insurance in order to reduce that risk for the lender. Well, with Bitcoin, the insurance doesn't just reduce risk for the lender, it actually benefits the buyer. So the payments you make into PMI are gone. You lose them forever. But the payments you make into a Bitcoin mortgage insurance product get held in escrow. And at the end of it, as Bitcoin is growing in value, you cut that and you split it 50-50 with the lender. So what happens is over a 10-year period, when you're making in these Bitcoin mortgage insurance payments, and there's no 20% equity bridge. So even if you're over 20%, you're still making your BMI payment. It's basically a dollar cost averaging strategy into Bitcoin that gets you the financing in the first place, right? Because you have a small amount to put down. You want the financing. You're not getting it from traditional, but you want this Bitcoin component. So instead of paying a private mortgage insurance, which you're already going to pay anyway and get no benefit from, only the lender benefits, come to us and use the Bitcoin mortgage insurance. And if you, and roughly the way this calculates is it's around $50 per month for every $100,000 that you borrow, just like PMI. That's like the average there. So basically you could be saving about $200 a month in Bitcoin. But what happens is with a 60% compounding annual growth rate, or even just you cut that in half to a 30% compounding annual growth rate, it's a 30-year loan. So by the time you're a year and 15, the Bitcoin, the 50% of the Bitcoin will pay your entire loan off from the borrower side.
Could you imagine that if you were able to reverse your entire interest payment on your loan through paying into a Bitcoin-backed PMI?
And then on the lender side, they get the other 50% of that value. So when 50% of that PMI escrow is worth the remaining amount of debt, it automatically gets liquidated. The debt is closed. You own your home free and clear. You're debt free. And the lender gets the other half of that value, which boosts their yield. It reduces their risk and it boosts their yield at the same time.
So the PMI is essentially accelerating your mortgage.
So instead of the PMI just reducing risk for the lender, the BMI is working towards it's building equity for you and it's eating away at that debt foundation. And when it gets to that extent, boom, it's triggered. So if Bitcoin has a big year and moves up more than we anticipate, right? Bitcoin tends to make these moves 5, 10 days out of the year. And when it makes that big move, it might get you into a position where you get a call from us and say, hey, congratulations, you now own your home free and clear. Have fun.
Amazing.
So it's a Bitcoin mortgage insurance. This is just one example of what we're doing at People's Reserve. And this is what I mean when I say we need to take Bitcoin and integrate it into our economic, monetary, and fiscal policies. It is an engineered money. So we must therefore financially engineer solutions to the problems that we face. Housing affordability is a real problem. BMI product.
50-year mortgages now, for crying out loud.
And the problem with 50-year mortgages is they're trying to solve for affordability by reducing your monthly payment. So they successfully reduce your monthly payment. But let's not even talk about the interest that you have to pay, right? Because you're paying significant more amount of interest. But let's be honest, The average length that somebody owns their home is about 10 years.
Right.
So you can, and then if rates go lower, you can refinance. So you can save on that. I'm not worried about the interest because you're going to refinance or you're going to sell within 10 years anyway. Nobody's making a 50-year commitment. It's a financial tool. But here's the difference. In a 30-year mortgage versus a 50-year mortgage, it's the equity that you build. And what people need to understand is most of the times it's that equity that you use as the down payment on your next home.
Right.
So talk about affordability. You might save a couple $100 per month on your payment, but in 10 years of payments, roughly speaking, at the average cost of a house, in 10 years worth of payments, you will have $32,000 less equity. So in a 30-year mortgage, you'll have around $50,000 of equity at that 10-year mark. So if you're going to move, you can roll that 50 as the down payment into your new home. That helps with affordability. On this side, you're only going to have $18,000 of equity. Now you have an $18,000 down payment to roll into the next property instead of $50,000. So it's not about the extra interest that you're going to pay and refinance and whatever. What it's really about is it doesn't solve for affordability because it makes your first home that you buy a little bit more easy to pay for month to month, but it makes that next home you're going to buy unaffordable because you couldn't build equity quick enough because of the amortization schedule.
Yeah, you never get ahead.
You can never get ahead. This is not 50-year mortgages are not a real solution. 100-year mortgages are not a real solution. By the way, Japan tried that. It didn't work. And they tried it at the end of their currency life cycle. So we need to, these warning signs are going off. It's time to financially engineer. It's time to create revolutionary, innovative products that leverage Bitcoin and stablecoins to not extract value, but to deliver value. And the BMI, to me, is one of the best solutions we have to solve the housing affordability crisis. Yes, the prices need to stay where they are right now or even come down a little bit, but you can build equity over time through the BMI instrument. And that's the game changer, because the faster you can build equity, the faster you're financially free. And the faster you're financially free, the more you're contributing to the economy. And then everybody's quality of life and standard of living goes up. This is the power of the technology that we have at our hands, and we need to move with it, and we need to start to integrate.
You know, I want to give you the opportunity as we close. First of all, before we close, I want to make sure you give all your contacts so people know how to find you and where to get more information. But I want to also touch on financial literacy for young people, because we're entering a time where the current generation of young people feel like they don't have any control over their financial future. They can't own a home. They can't get ahead. Their dollar's not going as far as they wished it would. The American dream is kind of slipping through their fingers. We've spent decades sort of subsidizing the boomer economy, and this generation has carried that to a great extent. What advice can you give this generation to leverage this incredible pristine asset and these new rails of commerce to try to get ahead? I mean, I think that's a great closing message for this conversation.
Yeah, and thank you for the opportunity, because this is something I'm really passionate about. It starts with education. It really does. And I'm going to say this to the older generation, and then I'll address the younger generation. To the older generation who love your kids and your grandkids and humanity, and you want to leave the world a better place. Are you surprised that the education system has become what it's become when you pay teachers like they're babysitters? When you allow these different curriculums to crawl their way into the schools and rip out truth and rip out goodness and provide distractions? Are you a boy? Are you a girl? Just stuff that is not relevant to empowering a young child who needs to understand the facts of the world and to get aligned with truth so that he can truly accelerate in his education and deliver value to the economy. A lot of this younger generation is so confused because there was a failure there. The teachers were treated like babysitters. The curriculums were corrupt. We need to get back together, and we need to fix that, and we need to do it immediately. Now, if you're in the younger generation, and this is a legacy, so if you're in the older generation and you're working towards that, please reach out, because People's Reserve will support you in that effort. Now, if you're in the younger generation, the system isn't going to save you. You really, truly, honestly need to understand that. You need to save yourself from the system, because even with the advent of these technologies, even with the elonging of the path that we can kick the can down the road, eventually there is coming a bigger change. Eventually there is coming something where if you're not prepared for it, you will become completely dependent upon debt to live your life. And when you're in that scenario, you don't have the ability to build a future for your children. I've been blessed with 4 children. They are my motivation. They are what get me in here to make a better world. People's Reserve is not about making money. Buying Bitcoin isn't even about making money. It's about creating a system that is more fair. It doesn't care who you are or what you've done. It just cares how much you have. It just cares if what you say that you have is true or not. And then all it ever tells you is, yes, what he said is true, or no, what he said is a lie. And it does it without mercy. The world could learn from this. Sometimes you need to tell somebody no, and you need to be hard on them. And most of the times, it's not somebody else. You need to be saying it to yourself in the mirror. It's a self-realization that you need to wake up and understand there are bigger forces here at play. It's not just about what you learned in high school. It's not just about what you went to college to learn. It's not just about the little bubble that you're in. The bubble that everybody else is in creates an aggregate bubble. And within that bubble is the relationship between marketplace participants. And if you want to know what I mean by that, when's the last time you went out and had dinner? How has your server treated you? How about when you go somewhere at the checkout line? Ever have a conversation with a checkout person, or do they just scan and tell you the total and leave? What's happening is society itself is degrading, because when you're a server and you're making $400 a night and you still can't buy groceries, you don't go to work happy. When you're working on minimum wage and you need to borrow money and get food stamps just to get by, life isn't fun. So this is about teaching our generation to embrace technology to empower themselves, because you have a system that is extracting value. And now we have this alternative system that is delivering value based off of good, not based off of monopolistic economics where, hey, we're the G-SIBs. Use us or everything fails. Too big to fail. What? There's no competition. There's no way to actually create a free market. In decentralized finance with stablecoins and Bitcoin as the equity layer foundation, it's true free market competition. People's Reserve has to create products and services that incentivize you, that create value for you. And if we don't, you won't ever know who we are or use any of our products. We can't force you to do that. This is the real power that you have. You have the ability to embrace Bitcoin as a savings technology, embrace stablecoins as a spending technology, and think of them as tools. You have 2 tools to get ahead in your life, along with your education and your motivation. So think of not just your education and motivation, but also the tools you're using to support your education and motivation. And the best 2 most important tools you can have are spending technology and savings technology. And I think, of course, too, also throwing in a wife and some children will make life a lot more fun to go through with. But it's a personal decision. But when this comes down, it's clear as day. There's no argument. The technology now exists today for you to escape the matrix. You don't have to wait for someone else to pull the plug. You can pull your own plug. And by doing that, you will get all the benefits that come along with the technology. Make sure you are using trusted resources like Stablecoin Solutions, People's Reserve, all these Bitcoin. There's a lot of, what do they call them now? I forget what they call them now. Key opinion leaders, Coles, right? Ignore those people. Find the real signal. Ignore the noise. Find the signal who are people giving their time and energy to educate you, like we did on this show here today, and dive as deep as you can. Dive as deep as you can for your own sake, for your children's sake, for your children's children's sake, because the world is changing at a rate and pace that I didn't think was possible when I first started. I did not think it could change at this rate and pace. What's that famous saying? You have days that go by, decades go by in days, and days go by in decades. We are transitioning to where decades go by in days. Genius, absolutely. Market structure, these are decades that will go by in one day of voting. And you need to pre-position yourself now, and you will get financial freedom. That's the value prop. Financial freedom. And there's no greater freedom besides freedom of speech, freedom of religion, and financial freedom. You have those 3 things, you're going to live a fun life. And if you live a fun life, then you're going to help others live a fun life. And that's the real reward, to go through life having fun, having abundance, having relationships, helping others. And isn't it amazing that it all comes back to money? I believe that's why the Bible says the love of money is the root of all evil, because money is a core critical foundation of all society. And if you love the money instead of the people, then it's the root of evil. But if you love the people and you have a good money, there's no telling what we can do. And that's the hope that we have in Bitcoin.
I love this conversation. I love your passion. I love the message that you're sending to young people about financial literacy and using technology. Tell the people how they can find more about you, CJ, and what you're building.
Well, thank you so much again for having me. This was an absolute pleasure. These are the most important conversations taking place in the world right now. So it has been an honor. And if you want to learn more about me, you can follow me on X at CJ Konstantinos. Of course, People's Reserve at People's Reserve. And you can go to peoplesreserve.com. And if you really want to follow with each one of the things we're doing, you can go to the People's Reserve newsletter and just sign up there and we'll stay in touch. But I look forward to, I'm very active on X. So if you get on X and you start interacting with me like I did with you, it's very easy to have a conversation, and I'm willing to help in any way that we can. I believe this is a fight for humanity. This is a fight for freedom. And I'm going to do everything I can to make sure that we and our children have a better future. So get active, get involved, follow, interact with the community, learn, educate yourself. And there's no telling what we can do. It really is up to us. We have the power and we have the ability to change the world. Now let's come together and let's do it.
Well said, CJ. Thank you so much. And thank you to everyone who tuned in to episode 2 of Stablecoin Solutions. And I will get this up and live as soon as I can, CJ. Again, a delightful conversation, and I look forward to seeing you on those X spaces in the very near future. Thank you, my friend.
Thank you.